Well, hello there, friends, and welcome once again to another edition of the 360 Experience podcast. I'm your host, Tim Braheem, and today's episode is with what I believe to be an up-and-coming superstar in the mortgage business. And I say that a bit about Scott Taylor as a 65-year-old man, okay? You heard that right. He started in the mortgage business at the age of 64 in 2024 in April, so about 18 months after the recording of this episode. And in a short period of time, in what is by everyone's measurements, a very difficult market to break into, much less thrive and survive in, he has done some pretty special things. This is a man who, at the time of this recording, has 17 loans in his pipeline right now and is on the cusp of having a month where he's going to fund 7 loans. And he's only been in the business for 18 months. And how he has done it is by working hard, but also by working smart and really leveraging his network. So for all of you that are about to listen to this episode, I really want you to expand your thought process of what is possible. Now, in this conversation, after we get to know Scott a little bit for the first 15 or 20 minutes, I'm going to turn the tables and I'm going to coach him. And he's going to bring a few issues to the forefront that he's challenged by right now in his business. So you're going to have an opportunity for me to hear, you're going to have an opportunity to hear me responding to his challenges and coaching him live. Before we continue, I want to just say thank you if you're a subscriber. If you are not, please subscribe and give us a like and or a comment on your favorite podcast channel and forward this to anybody who might be of benefit in listening to it. Now, without further ado, my friends, my conversation with Scott Taylor in the 360 Experience. Scott Taylor, I'm super happy to be with you today. You know, I said in the intro that I first became aware of who you were in watching a Zoom session that you and Josh Metal did together. And man, it really lit me up when I watched it. I mean, I'm sure that you can imagine as a teacher and a coach, one of the most important things in my world is that there are students that actively learn and grow and implement. And, whenever I see somebody that's implementing, it warms my heart, and you've done just that. And it was great to meet you in Las Vegas at Mastermind, and I'm super happy to be here with you today.
I'm honored to be asked to do this with you. Lots of things have happened, Tim, since April of last year when I got my license and got into the business. And if you'd have asked me then, am I going to be interviewed for what I do in the mortgage business, I'd have told everybody they were crazy. But it's an honor to be here, and I am happy. This is such a great community. I really love being a part of it.
Yeah, I know that honor. 1995, to be exact, is when I was interviewed for the first time. And I'd been in the business for about 3 years. And it is really nice to be able to share and help others. And I think that you'll be able to do that today. I mean, one of the reasons that I wanted to talk with you is because of the relatively short term of business experience that you have in the mortgage industry, which is less than 18 months, but you've had tremendous success. So let's just highlight that success for a moment. Tell us a little bit about, we know you've been in the business for about 18 months, but what type of loan volume have you done, and where are you at right now in terms of the size of your pipeline?
So it's funny. So when I started in April, the place I started was not a good fit for me. And I'm told that this is kind of the old way of things happening. But the guy that I was working with at the time when I got my license at first, he was one of those, okay, you're going to sit here, you're going to call people, you're going to grind all these calls out, and you're going to try to find people.
Mm-hmm.
And that's not me. I got into the mortgage business, Tim, honestly, because I have a whole huge Rolodex of people. I was blessed to be a part of the baseball community for 50 years as an umpire supervisor, as the boss of NCAA umpires. So I have a large everywhere. And so my vision when I got into the business originally was that I was going to leverage all the people I knew in all these different states, and I was going to go and try to make a big splash. And that wasn't going to happen where I was before because he didn't want to sponsor licenses, didn't want to get a broker's license in other states. So not that it was a bad situation. I learned a lot. He's a great producer, the guy I was with, but I needed a home that allowed me to be me and the direction that I wanted to go. So I needed to find somebody who was already licensed in multiple states and wouldn't be a problem. And me going out and getting licenses and already be matched up with somebody that already had that. So made a move in January of this year, 25, to a new home, and it's changed everything for me. So it's what I originally thought it was going to be.
I had no idea, first of all, that you were an umpire. And I don't know if you know this about me, but you probably don't know too many more passionate baseball fans than me. I mean, that's my sport and it's been my whole life and I love it like it's a family member. So we have that in common and we could go down that rabbit hole, but we probably shouldn't because there's a lot to learn from you here beyond that of umpiring. But what I love that you have started us off with. Now, before I continue, how old are you?
I'm 65. I'll be 66 in December.
So you're a 65-year-old man that got into the mortgage business at the age of 64 in April of 2024. And the first place that you went was a place where you were told to just pound the phones and do a lot of cold calling, and that just didn't resonate with you. And you had this network of people from a previous life, and you wanted to be able to leverage that network, but you were kind of shackled and handcuffed in being able to do so as a result of not having licensing in different states. And what I want to highlight for everybody is this, is number one, we're talking to a man here who has started a new career much later in his life than most of all of you that are listeners have done so. And you have done it in a difficult environment where most people get into the business and rates are low, and that's why they get in the business. And there's a lot of low-hanging fruit that they can pick, which is refis. So you couldn't have gotten into the business at a more difficult time. And you recognized right away that your network is your net worth at the end of the day. And I want to highlight that for everyone. You all have a network. It may not be as big as Scott's. It may not go into other states, but all of you that are listening know a lot of people, and that is a wonderful first place to start. So tee us up real quick. What was the approach starting in January when you went to the new company and you could now, take the handcuffs off and start calling on people who were in other states and you could serve them? What was your approach of just reaching out to them and introducing the new version of Scott Taylor to them?
Well, most already knew. I'm a big social media guy, Tim. So a lot of people already knew what was going on with me and what was happening. But making the move was different because now I was able to better serve people in this role. But I didn't ask for anybody's business from the start. I think the thing about the previous place, Tim, for me that I worked is that even though I made calls and I talked to people, I was really able to focus for the first 8 months on the education piece of what I came into. I'm an LO at Nexa, and coming into Nexa, for me, I was able to hit the ground running. That was when my mortgage career really started, if you're going to be honest. I mean, last year in 24, I only did 8 loans, 8 in 8 months. So that was a struggle. I'm fortunate though. I'm of retirement age. I tell people the most dangerous thing, Tim, is a 65-year-old man that doesn't need money. And that's what I am. I've earned. But this was different for me because this is where I honestly, for the first time ever, get to serve. And that's really why I'm here. I've been a part of having mortgage people tell me things that ended up not being right. And so I've done that journey a couple of times. I also was fortunate enough that we paid off a 30-year mortgage when I moved to Indianapolis to be with my wife in 8 years. So I already knew some of the secrets. I already knew some of the strategies of what to do. It was about, for me, I don't sell loans. You say this really well in a lot of your teachings. I'm a debt manager, and I've really taken that to heart. And so I don't approach it the same as most mortgage lenders do. I'm a little different. I am a relationship guy, and I'm able to leverage those things. I asked all my friends on Facebook, and I'm like almost at my limit of 5,000 on Facebook. And I asked them all, I said, look, I'm starting a business. Here are the states I'm starting in. If you know anybody who's a real estate agent or somebody looking for a mortgage, would you just think of me and let me meet them and talk to them and see if we're a fit to do business together? Tim, when I did that in January, I immediately had 20 people teed up for me by friends. This is Scott. This is what he does. He's great. If he can help you, he will. And I'm blessed with great friends. I'm blessed with a good network of friends. So it's about the customer service part. They know me. I have a reputation for being a good friend, I think. I think I have a reputation for following through on the things I say I'm going to do. And people know that. So while this is my first dive into the mortgage business, it's not my first dive into sales. I mean, sales is sales. You're going to learn things, you implement things, and you provide great customer service and treat your clients the way that you would want to be treated if you were a client. And that's really all this is, Tim, for me.
So we're recording this in early to mid-August. I guess it's mid-August today. In mid-August of 2025, you started the new company in January of 2025. Here we are 8 months later. I want to go back in a moment and comment on your first 8 months in the business, but now what do things look like? How many loans have you funded year to date, and how many loans do you currently have in your pipeline?
I have funded 17 loans, but the last 3 months are the ones that's been really the most active. I have right now 6 loans that are just finishing up right now. I've got 5 more closings this month. And then I've got another 15 to 16 loans in my pipeline that are just starting to gather documents on and do things. I'm starting to take advantage of refis, which has not been an option for me in my short time in the business yet. And I'm starting to see some openings, and I'm starting to see some places where I can help some people. So the pipeline's going to be full. It's going to be really, really ugly here in the next couple of months, I think.
Ugly in a good way. Let me put something into perspective here for everybody that didn't do the math. So probably by the end of August, you're going to have averaged 3 fundings a month in your first full year in the business. From January of 25 to the end of August of 25, sounds like you're going to fund 23, 24 loans, something like that, and a nice pipeline going into the fall months to be able to continue that pace. So great job. And in today's market, I mean, I know loan originators that have been in the business 10 years, Scott, 15 years, that are only funding 3 to 5 loans right now in today's market. And you're doing it with only, a little over a year worth of tenure under your belt. Now, I think there's something very important that you stated earlier that I don't want the listener to miss on. Those first 8 months in the business that you deemed as being not all that successful, you funded 8 loans in 8 months. First of all, that's pretty good considering the market. But more importantly is what you highlighted, that those first 8 months you were spending your time really becoming a student of your craft, really understanding how to structure a loan, what loan products are available, how to sell them, how to present yourself. Maybe you could comment a little bit about the foundation that you laid in those first 8 months of learning the business that then gave you the confidence when you opened up your 5,000 person social media account. I mean, think about it for a minute, everybody. I mean, you could have 5,000 people on social media, but if deep down inside you're worried that you're going to drop the ball and look bad in those people's eyes because you don't really know what you're doing, you're going to be reticent to sending out the message and saying, hey, I'm here to help. But you were brave enough to do that. But I would guess that some of that bravery comes from the fact that you were a student for those first 8 months.
I think that I'm able to talk the business way better today than I could before I came to my current location in January, for sure. I think it's baptism by fire a lot of times with me. I'm finding myself, here's a baseball correlation for you. As an umpire, you can only say you kick that call so many times before they're going to start expecting that you're just going to kick a call and be wrong. I find myself apologizing a lot now because there are still some small technical things that I'll misfire on that I have to, and I own them all. I literally do. You have to. Leadership starts somewhere, starts at the top. I've started to develop a staff around me. I now have 3 assistants, which has changed things for me a little bit because I'm now able to go out and hunt a little bit more rather than be stuck in the office and trying to meddle through what could possibly go wrong or trying to put out fires along the way. So I'm not doing as much of that now, which has helped a lot. But it's just, I still find myself from time to time having to slow myself down and say, okay, let's just slow down from a 9 to a 7 to make sure we get it right the first time. And that's the one thing that I have tried to take to heart a little bit more. I tend to go really fast. I grind. I mean, I'm here 5:30 in the morning until 6:30 at night. And I'm doing that, at least 4 days a week. And I might take Friday off a little bit, but you're kind of keeping me from getting out of here on Friday early today. Sorry. But I truly love this. This is the best gig I have ever had in my life. It really is. And people don't understand it. I just love it
so much. I can feel your passion. Share with us what it is that you love about this job so much.
Every day is different. Every single day is different. People don't like jobs, Tim, because they go back and they do the same thing every day, in, out, do that. That doesn't happen here in our business. There's a new challenge that hits me every single day, whether it's a loan, whether it's the way I should have processed and set it up, whether it's a leadership issue. I'm finding, I didn't personally develop till I was probably in my early 50s. I didn't understand the importance of it. But the things I've learned over the last 10 years and the relationships that I've grown over the last 40 have prepared me for this day, this season of life. And I'm on a 5-year plan, but I don't even see me shutting down at 70. Honestly, Tim, I just love this so much because I get to meet people and see people and help people every single day. If you're not enjoying what you're doing here, then this job can be a grind, but I love it so much. The hours that I work every single day, they fly by. Like no other job I've ever had.
So take us back now to more towards the beginning when you were first learning in those first 8-10 months pre starting to fill up your pipeline with 3, 4, 5 new loan applications every month. What were some of the places that you went? How did you learn? What gave you the confidence? What are some of the things that you studied that you feel really were foundationally important in you being able to have some of the success that you've already started to have?
Well, the first boss that I had, the first broker I worked for, and I have admitted this openly on multiple occasions, I really thought that I could go out there and go straight at consumers without the help of realtors. Boy, was I wrong. And I admitted that to him towards the end when I had my exit interview. Actually, I said, look, I know you're right, and I'm going to have to get better at that. But moving and going to a new location forced me to go into that mode. I've got a lot of good realtors. I've developed a lot of good relationships with several realtors in several states. And that's been the biggest change in my business. And I think the biggest change was helped from the fact that I come from a standpoint that not many do. I'm not a guy that's going to call you and say, what do you got for me? I'm a guy that's going to send you educational information a couple of times a week as a realtor. I'm going to be the guy that is going to offer you leads. I mean, I talk to a lot of people. Well, who's your realtor? I'm constantly grinding into those questions because I want to be able to serve my realtors. And I was very stubborn in the beginning, thinking, you know what, sometimes realtors just get in the way of getting a deal done. And I've learned that that's not always the intent, but you have to also look at it and say, you got to get the right realtor. You know, there's a lot of people, there's 70% of the realtors. We all know this, 70% of the realtors in 2024 didn't do a deal, didn't do a single deal. And I had a lot of those on my roster in 24. So I had to upgrade my thinking a little bit on that.
So you're asking clients very actively, what I'm hearing is you're asking very actively who their real estate agent is, and you're trying to position yourself as a referrer to real estate agents. I think it's quite interesting that you've cultivated real estate agent relationships with people in other states. I would imagine that some of the listeners are saying, scratching their head and saying, wow, how do you go about doing that when you're not belly to belly with them? So maybe unpack that for just a quick second. How have you gone about developing rapport with real estate agents in states that you don't reside in?
This year, I'm licensed in 17 states. Okay. This year already, I've been boots on the ground in 14 of them. Wow. So you can't say that I'm not face to face with them, because I might be developing relationships with them on social media, but I will also go. And that was my life as an umpire. Jump in a car and go. I don't like flying. I mean, I will. I mean, if I'm going, I'm licensed in Arizona and Nevada. I'm obviously not going to drive there, but I'm from Oklahoma, born and raised. I've got a whole house of Coldwell Banker realtors in my hometown. I've got 11 of them right now. And basically, that's my house. I get that business. That's changed. I've got 5 deals in the pipeline or about to close right now that are from that house. So I am belly to belly with these people. They have to know who I am, and they able to feel my passion about what I'm trying to do, what I'm trying to do for them. It can move more to an online business later for that, but I want to go see you. I'm going to meet you. I'm going to get a feel for who you are as a person and how you do business, and do we align? So for me, that's everything. I've been to North Carolina. I've been to Georgia. I've been to Kentucky and Tennessee and Ohio and Michigan and Illinois and Oklahoma and Kansas, and have done deals, or am currently getting deals in all those states. And I think it's because I went out and did it. So there's a couple of more states I need to go hit here, but I try to schedule it, Tim, to where I'm on the road for 3 days, at least 1 week a month, and sometimes 2. And wow. If I can get that accomplished, and my wife is great. Brenda is my biggest fan. She's my biggest supporter. And she knows what this is doing for me. And she's a big supporter. And we have no kids. We have dogs. So, I don't have to be there all the time. There's not a whole lot that I have to help with. She's a big girl. She handles most of everything, including me, on a daily basis.
Well, I want everyone to take note of the effort and the commitment. I would imagine that a lot of people that are listening are saying, well, I can't imagine myself jumping into a car for 3 days out of the month and driving around to different states to meet real estate agents that I've never even met before, in an effort to hopefully get them to send some business to me. But, and I know this to be true from my own personal experience, because I used to do business in a town called Ojai, California, which was about an hour from my office in Westlake Village. And I captured that entire market, and that market was worth a lot of money to me. And I know that the message that you're sending to them when you go to visit them, and they have to say to you, I'd imagine, you drove here from Oklahoma? I mean, that's an impression that you're creating of wow, this guy, think about the message that's being sent here. If this guy's willing to get in his car and drive 2 states away to meet with me, to take me to lunch, that's quite a commitment that this man is making. and it says that I can count on him. If that's the kind of effort that he's going to put in to meet me, it's very flattering that you would drive that far to meet somebody and get belly to belly with them. What does that say ultimately about what they can count on from you to be the lender that represents them and acts as a true partner to them? So I think that that's pretty remarkable. Now, what we're going to do right now is we're going to take a quick break, and we're going to hear from our sponsor, the Loan Atlas. And then when we come back, we're going to turn the table a little bit, and I'm going to be coaching Scott on whatever it is that he's brought to this conversation. So stay tuned.
Out of curiosity, why do you think it is that some originators are sitting around with empty pipelines while others are having some of their best months ever in their careers? Well, as a coach and faculty member inside of the Loan Atlas, it is abundantly clear to me that one type of originator is armed with the information, the inspiration, and the implementation coaching they need to ensure 2025 is more successful than 2024. If you're ready to turn your goals into reality, the Loan Atlas is here to help. Click on the link in the description to schedule your complimentary success consultation now.
Okay, so let's turn the table now a little bit. How can I serve you? Where's an area or two that you're dealing with in your business right now that you'd like some help with that I can guide you on as a coach?
So I would say right now, the number one thing that I'm trying to gear up for is more refis. I think that season is coming, and I haven't seen it yet, honestly. And having the conversations with people is easy. Getting them to change. People are resistant to change, Tim, and I'm battling that a little bit. Once I get through to them, they understand it, and they wish they'd have done it 6 weeks ago when I started with them. But I'm really trying to get into refi season, so I'm trying to figure out what it is that I need to do to tee myself up for that and be prepared, because I just think we're on the front edge of something that's really going to be the next 12 months of my life, and there's going to be a whole lot of activity. I want to be ready for that.
Well, I can tell you this from personal experience, time and time again, that it's not a bad time when there's refis. I mean, as Craig Strent, the head of faculty of the Loan Atlas, always says that, you make you pay your bills with purchases and you retire on refis. I mean, the refis are the gravy that is the reward from all the purchase transactions you did. So when you say that you have been engaging people and they wish that they would have done something 6 weeks ago and that they don't like to change, elaborate a little further. Are you saying that there are some people that you've approached where it made sense in your mind for them to refi, but they were resistant to doing so? Is that what you're saying?
Mm-hmm.
Okay.
Yeah, what's the net value for them? They're looking at it and go, I'm already in a 6.75. I'm in a great shape right now. Why would I want to refi it now? And they just don't understand where I can take them.
Okay. So first of all, the first thing that we need to recognize is that there are essentially a variety of different presentations that we do as a sales professional in this business. One of them is a purchase presentation, and that one might be one where you create an analysis that compares and contrasts their existing rent situation versus if they were to buy a home, or their existing home if they were to sell it and take the equity in that home and to buy up to another home, what that might look like. And you're presenting numbers based upon these variety of different circumstances. Refis are a little bit different. We're not talking about them buying another home. We're talking about them being able to utilize either a lower interest rate to save them money or the equity in their home to create more available cash for other things that they might need in their life. So it's a different presentation, and I really respect what you're saying, which is that it's not one that you've delivered very often, so you're getting used to that. So before I get a little bit prescriptive here, my next question is this. You've got somebody currently at 6.75. What are you trying to convince them to shift into?
I've done enough education on this. I don't have, a lot of my people are older. I'm old, so I've got a lot of people older. If you're in a mortgage, I'm always trying to sell rate and term, and I'm wanting to do the term. I don't want them to just save cash flow. So I'll make that presentation, and I'll give them 3 options of what I'm trying to do. but I just find that a lot of my people that I'm talking to, and it's not even because they know the fact, 3/4 of them don't even know who the guy was that did the mortgage for them in the first place. So it's not that. So I've got the relationship, so I already win there. But it's providing enough information for them, Tim, to be able to make a quick and educated decision.
So are you trying to convince them to go from a 30-year fixed at 6 3/4, that they have 29 years left on or something like that, down to a 15-year? Like, what's the sell that you're trying to present? That's what I'm trying to understand. Because, I mean, the reality of it is that at the time of the recording of this conversation, if somebody's locked in at 6 3/4 on a 30-year fix, it is actually a pretty tough sell because rates aren't really any better than that. So what is it that you're trying to sell so I can help you through that?
So let me give you my example for today of what happened so that you will get that. Mm-hmm. This guy was he is literally 4 months in on a bank loan, and he's at 6.75%. It's at the $806,500 threshold right now. He's in a 6.75. His payment is right at, with escrow and everything, probably right around $6,000. But I was able to find a rate today and finally get him to talk to me about this. I can put him in a less than 6 on a rate and term refi. And I can put him in 20. I could put him in 20 years, Tim, for $300 more than what he's paying. And I know he can afford that. I know what his income is. He's a friend of mine. So I pitched it today. I said, look, I think it's $280 more per month. But I'm going to save you this much. It was almost $500,000 in interest that I was going to save him over a 10-year period of knocking it down from 29 and change to 20.
So are you providing this, like the way that I used to do it is I would provide the analysis in the form of your current loan structure and then side by side with the new payment and what it would save, to your point, in the way of a big number, which is, in this particular case, you're knocking off 9 years and 8 months off the loan. So you're saving all the interest over the course of those, almost 10 years. Are you presenting those side by side? Is that what's happening?
Yeah, I actually do. On this particular presentation, I did the current loan where it's at now. I did a 20-year and a 15-year. Did both. The interest rate on the 15-year was really, really good, but he wasn't willing to step up to that. And I understood that. I knew where he would fit. I knew the 20-year was where he was going to fit. I knew it going in because I know him. But I stretched a little bit and said, if you do this, but ultimately the 20 years the one that was going to work, because I think there's going to be another opportunity here in the next couple of years to go down again. I think rates are starting to show themselves that I think we're going to get more rate bumps going down. So 20-year was fine with me, and that was the one that he ultimately chose. And so he did the application today, and I already submitted it. So I'm talking about a success here, but that's also a friend. I'm trying to do this for everybody who will listen to me. So there are going to be some people that I'm going to talk to that are going to be referrals and not have a relationship with, and I'm trying to get my messaging right for that.
Okay, so I got the full picture now, and thank you for sharing that. So let's look at this through a few different lenses. First, the lens of the education that you provide to people in advance, your presentation, which will get them to open their mind to a different perspective. It might sound something like, and I'll just kind of spitball it out of my back pocket, Scott, here, is that, Scott, one of the things that I know to be true from doing this is that a lot of people are very fixated on the interest rate. And what they're not really looking at is what does that rate ultimately cost them over the duration and life of the loan. Given your age, being 65 years old, I would imagine that a 30-year loan isn't something that, God willing, maybe you live to be 95, but I certainly know that you don't want to be paying on a 30-year mortgage at the age of 90. Okay, so what we should be talking about here is how can we accelerate this payment and save you a significant amount of interest over the life of the loan and get you into a position to where whatever, income that you have coming in that's in the form of passive income in the later years of your life is just going into your bank account and providing for lifestyle rather than you having the stress of having debt hanging over you. I want to present to you some different scenarios that I think are worth taking a look at. And a lot of the clients that I work with are opting into these scenarios because it makes good sense for them because they have similar circumstances to you. I think that's a very important footnote that I'm going to go off script on, is that you want to intrigue people by telling them a story. So this guy, when you close this guy's loan, he becomes your story. Okay. You want to share his story in an ambiguous way with future people. Hey, let me tell you about a loan that I just closed that's a perfect example and why this gentleman decided to move forward with it, because he didn't want to be paying on his loan when he was in his 80s or his 90s, whatever. Okay. And here's what we did. For only $280 extra per month, we saved him $400,000 over the life alone. But more importantly than that, we got him out of a stressful situation 10 years earlier than had he stayed in the loan for 30 years. You want to intrigue people with stories of people like them. That's why when you buy something online, I mean, this has been this way for over a decade now. People like you liked this movie, or people like you bought this product. Okay. That's why they use that phraseology, is because you want to make sure that they feel like they're questioning why they wouldn't do the same thing that somebody else just like them did. So I would suggest that you bring that into your dialogue. Now, there are people, Scott, in today's market that simply can't afford to pay the extra $280 a month. And in that case, you could pivot, and I don't know what the interest rate would be on a 30-year fixed rate mortgage right now, but you could also show in a third column what I used to refer to as a same payment refinance. So let's hypothetically for a moment say that you could get this gentleman down to 6.25% on a 30-year. Okay, that saves 0.5%. That would, in essence, save him money on a monthly basis. But what would it look like if he refied and made the same payment that he's making right now and applied the additional savings to the principal? That might knock the loan down from the 29 years and 8 months that he currently has on the loan down to, say, 24 years and 5 months or whatever the number is. And there's still a big savings there net. And that gives him the flexibility as a safety net to pay the lesser payment on the 30-year amortization on a monthly basis if he feels like he needs to. But you're also bringing to the equation the option of prepaying the principal and getting the loan paid off faster. Now, the other thing that I want you to be looking out for in the future, it's not there yet, but boy, did I sell this product a lot when I was in my career as an originator, would be what I would call the intermediate fixed rate mortgages is what I refer to them. I didn't refer to them as adjustable rate mortgages. The 5-year, the 7-year that converts to an ARM, the 10-year that converts to an ARM. A lot of the times when the yield curve is more normalized, and hopefully it will be with a few Fed reductions, you'll start to see that shorter end of the curve drop, and you'll start to see the 5s and 7s coming back into play. A lot of the times you can get somebody into, maybe the high 5s, even mid 5s on a 7-year fixed. And now you want to start presenting to them this question. So I know that 7 years doesn't sound like a long time, Scott, but what I'd like you to do is this. I'd like you to turn back the clock for a moment for me. Let's go back 84 months ago. If you can go back to 7 years ago, how has your life changed from then to now? What's different? Oh, okay, you bought a new home. You weren't even in this home. Or, oh, you changed careers and you now make more money. Or, oh, you've added, 2 people to your family because you're growing a family and now the house that you were in was too small. You want to put some perspective around that time frame. And you want to also create comfort. And that comfort sounds something like this. Scott, what I specialize in is being the manager of one's debt. You have an asset manager who manages the asset side of your balance sheet. And you have a debt manager, hopefully, that manages the debt side of your balance sheet. Most people that do what I do for a living don't take that part of the job very seriously. They get their paycheck when they close your loan and they never call you before, which is evidenced by the fact that you did your current loan with somebody else and you're not talking to them right now. But I don't operate like that, and that's not a mistake that I'm willing to make. This isn't going to be the last loan that we're going to do together. In fact, once we close this loan, my job really just begins. Because my job just begins when your first loan closes with me, because from there it's my job to assist you in managing the largest indebtedness that you'll ever take on in your life. So what we will be doing is we'll be establishing a new strike rate once this loan is done. So you'd go back off script now, you go back to this guy, okay, that you're going to take down to 5 7/8 or 6% or whatever it is on his 20-year loan. And what you want to make sure you're doing is you're now closing the next deal. And you're doing that by saying, Scott, here's what we're going to do. Our new rate that we're targeting is 5.5. And I'm going to be watching that very closely for you. You don't need to worry about it. You're going to see all kinds of noise in the media. Don't pay attention to it. Call me if you have any questions, but know that I am religiously watching it on a daily basis. And when that rate hits, we're going to strike. And this is what it's going to save you when that rate hits. And this is what it's going to do for your long-term financial plan. Either you now shorten it to a 15-year, or we just create some extra cash flow for you, or whatever the case may be. But you want to be closing the next deal now. And the same holds true for everybody in this big network of yours. And I want to really compliment you on having done a wonderful job of leveraging this network of 5,000 people on social media. So what I would be doing if I were you is I would be creating a series of educational videos and maybe written word that teaches people about what debt management really looks like and how we can maneuver in and out of loans and save people money. We can also, and I haven't even broached the subject matter of debt consolidation, so let's go there for a quick second. In every one of these conversations, you need to be asking the client what their complete debt load is. How many cars do you have payments on? How much credit card debt do you have? Do you have any personal loans that you owe on? Do you have student loans that have not been paid off, et cetera? And you want to do an analysis of their overall debt load now versus what it could look like post refinance and debt consolidation to assist them in creating additional cash flow. So what that could look like is this. Let's say that this gentleman that you talked to today has $30,000 in credit card debt. And the cumulative payment on all that $30,000 in credit card debt is, say, $5,000. I know it's more than that because you already said with PITI and escrows and all that, it's $6,000. But let's just, for argument's sake, say it's $5,000 for everything. Okay. And the mortgage part of it is, say, $3,000 or $3,200 or whatever. And you wrap it all into one and you have him pay the same amount he's paying right now on that new mortgage. So the $5,000 he's paying, including all the credit card debt, including the car loans, et cetera, what's it look like if he takes a new payment of $3,000 but prepays the principal to the tune of $2,000 a month? How much faster does he pay it off? What people get really excited about is the dream of being unshackled from the obligation of payment. Okay. And so many people in today's world are overextended and are worried about the future, and creating a true plan for them that shows them how they can be relieved of this obligation and stress that is the debt that they're currently holding by creating a structured, organized approach that you can provide is a winning formula. Let me check in with you. I know I said a ton there. I can get a little bit verbose and get a little bit excited about these things. Does that make sense to you? And is there any questions that you have?
No, because I actually just watched that talk that you had on the Loan Atlas last week. So I just got the benefit of getting it live. And I know that you have that down pat. So the teaching moment here for me is to get my scripting down pat, honestly. I mean, you said the same things just now directly to me that you said in a video that you probably did 2 or 3 years ago. That's amazing to me.
Well, and the reason that I can still say it and haven't done a loan in 20 years is because I said it so damn many times when I was an originator. I mean, here's a very important point you're making. I mean, at the end of the day, what do you get paid to do in this business? You get paid to advise and to teach and to articulate yourself. I mean, that's the common denominator of all the great originators, is that they can articulate their value proposition and simplify what is otherwise a complicated or intimidating process to a consumer and have it make sense to them. And I never recommend that you sell somebody on something that isn't in their best interest. That in my mind, that's inauthentic and lacks integrity. But to the extent that you can truly help somebody and better their situation, you're absolutely right. You need to have that presentation down because that's where your money is made. So yes, practicing this over and over. And what I would suggest you do is you go into that scripting in the Atlas, you print the document. I would highlight the key lines and phrases that you like. And then I would do what I did many times is I would record my calls with people. Now I used to do it on a tape recorder because I'm an old guy like you, but in today's world, you do a Zoom session with somebody, you have Otter, transcribe the conversation. You can read through it or go back and listen to it and critique yourself and ask yourself the question, all right, did I sound confident there? Would I have would I have moved forward with me based upon what I shared? What were the objections that I got that caused me to lose that deal? What was the thing that I didn't sound quite so convincing? How can I shore that up? Because that, at the end of the day, is where the magic happens, is when you can get really tight in your scripting like that, it starts to become like knocking down bowling pins. I mean, as long as you don't throw a gutter ball, you're going to pick up some pins, right? I mean, just get it down the aisle or down the alley and you're going to make magic happen. But that's where the practice comes in, is over and over learning not just how to articulate it, but what are the different creative structures that could truly benefit somebody. So, example, I would guess, Scott, for probably the last 7 years of my career, that 80% of the loans that I did were either 5 or 7 1-arms and an occasional 10-1. Very few 30-year fixed rate mortgages. And the reason was because I knew that it wasn't in the best interest of the client to do a 30-year mortgage. The only time that someone should be really taking out a 30-year mortgage at the end of the day is when 2 key components are in place. One is rates are at historical lows, which we're not at right now. And 2 is they're going to live there for a very long time. Because at the end of the day, the only thing that matters is how long do we need to borrow this money for? How long we need to borrow the money for tells us everything about what loan program makes the most sense and what amount of fees we should be paying as it relates to that loan program. So people would come to me and rates were, say, where they're at right now, around 6.5%, 6.75%, whatever it is. And I had a strong belief, as you do right now, that they're going to trend lower. Okay, so would it make sense for somebody to pay a bunch of points and fees for a loan right now? No, absolutely not. That'd be poor financial advice. Does it make sense for them to do a 30-year if a 7.1 is 0.5% better in the rate? I don't think so, because if I'm doing my job, I'm going to keep watching that loan. And when rates trend down sometime between now and 84 months from now, I'm going to be proactively contacting them and rewriting the loan. If you do the analysis on what the break even is, it's typically much further out. In the case of a 7.1 versus a 30-year, it's like 9 years. You'd have to be in the loan for 9 years, for God's sakes, for it to make more sense to do the 30-year. What are the chances the person's going to be in the loan for 9 years if you're doing your job correctly? Very little. Your job is to teach them that, to explain that to them in a way where they go, oh, wow, this makes complete sense to me. Yes, it's not risky for me to take the loan that is only fixed for 84 months because I know I'm going to hear from Scott again. You got to show them the cyclical nature of interest rates, show them graph charts perhaps that you can get from, say, MBS Highway, which is a terrific source for this type of historical data, and explain to them how the economy works, what the Fed's role is, what inflation is, what are the drivers of higher and or lower interest rates, including unemployment. Which, by the way, as a side note, one of the things I don't think that people are talking enough about right now, Scott, is unemployment. And I was talking to Barry Habib about this the other day. And, I think AI is going to eliminate a lot of jobs, bro. I mean, a lot. Like, I think a lot more than people realize. I mean, think about how many people you have out there with a side hustle driving an Uber or some other form of extra income. I mean, do you think they're going to be Uber drivers 5 years from now? Probably not. I mean, in a lot of the big cities in the country, we have robo-taxis now, and I don't think that's going to slow down. I think it's going to be more significant. So if you just start eliminating some of these jobs that artificial intelligence can replace, that's going to result in more unemployment, which is going to result in lower interest rates because the Fed will have to lower them to try to stimulate economic growth. Could even get to the point where the universal basic income could kick in where the government would have to start subsidizing and paying people, if you want to take the most extreme example of that. So your presentation is so important, and your instincts are incredibly accurate, I believe, that right now you should be, and what I want to footnote for everybody here is this is why Scott's been so successful so quickly. He's already thinking 3 steps ahead, which is what everybody's job is to do here, is think about where are things going to be 6 months from now or 9 months from now likely. Because the time to start having these conversations with these folks, the time to start putting this type of educational content out on your social media pages is now, not when rates drop and you become white noise because everybody else is jumping in and doing it at that time. You want to be the person that's educating them on something now that nobody else is educating them on, and building rapport and trust and credibility with them. And as Craig Strent says all too often, and he's absolutely right, don't underestimate the power of you saying to somebody, now is not the right time. That's a very important component of your scripting. So if you're talking to somebody and you're evaluating their loan structure for them, and you ask yourself the rhetorical question, would I move forward if I were them? And the answer is no. Then what I want you to say to them is, you know what, Scott, here's the thing. Right now, I do not think you should move forward with doing anything. The interest rate that I think that is go time for us is when we hit 5 7/8. We're not there yet. I don't want you to heed any of the advice of your credit unions that contact you or the online lenders that cold call you or anything like that. I've got this. I'm watching this for you. Here's why 5 7/8 is the magic number. Know that I'm watching it for you on a go-forward basis, and I'm going to proactively let you know as soon as the availability of that rate becomes an opportunity. Now you've built trust and credibility with the client because you didn't sell them something that wasn't in their best interest. Now they're going, okay, Scott's got me. He didn't try to convince me to do something that didn't make sense. So having these conversations right now is you lining up the bowling pins. So if rates drop in December or January, bro, you're going to have days that you've never had yet. Trust me, I've been there a bunch of times. Those days where you lock in 7 today and 9 tomorrow and 14 next week. And now you're going, holy shit. Number one, how am I going to facilitate all these loans? And number two, what am I going to do with all this money that I'm making? Because these are big numbers. Let me check in with you and ask you, was that helpful? Does it make sense? And what other questions do you have?
100%. So what you ended with actually comes to part of what my next thing that I would like to learn.
Yep.
I'd like to have a feel for if I'm going to start projecting and where I'm going to be 6, 9, 12 months down the line. I've just gotten to the point, Tim, my wife will tell you I'm a kind of a control freak. In fact, she wouldn't say the word kinda. She would say I'm a total control freak. And I've just now gotten comfortable with the idea of having staff on my team that will take all of the operation stuff off my plate. That happened right about the time I saw you in Vegas. But now it's like, okay, how many loans is it going to take before I'm going to have to ramp up staffing to keep up with the demand, because I think it's coming?
Yeah. So Caleb LeGrand, who I know you know very well from the Loan Atlas, has said many times that, and he's so right about this. This is a really powerful point that he makes. He said that most businesses, healthy businesses, build supply in advance of demand. I mean, that is one of the hallmarks of a healthy business. But in the mortgage business, because it's so cyclical by nature, and especially since there's trauma, I mean, and I don't use that word lightly, extreme trauma that happens when you come out of a market in 2022 and go into 2023, and you're having to deal with the uncomfortable conversations of letting people go. That creates a lot of emotional trauma, letting good people go. You know, you weren't around when that happened, but I want to paint a picture. So 2020, 2021, most of 2022, all of my friends and clients were making more money than they could have ever dreamed of. And their teams were working their ass off to help them make that money. And they felt an extreme amount of loyalty to those teams because they were the ones who made it all happen for them. All of a sudden, the market radically turns, and now you have to feel like an ingrate. Now you have to go to people that you love, that have gone to battle with you, and you have to say, I'm sorry, I can't afford to have you anymore. And most of them waited for a long time to cut that umbilical cord, and understandably so, because it was emotional for them. After you go through something like that, and you get into a market like the one we're in, and you're still dealing with the PTSD of that experience, it's kind of hard to hire into a speculative situation, which is what you're talking about. You're like, I think rates are going to get better, but I've heard that a few times over the last couple of years, and it hasn't really happened. We've had these short windows of opportunity. When is the time to pull the trigger is what you're asking me. Well, I think that you can do this in a little bit of a safer way in today's world. There are outsourced companies. One of them is called Night Owl. Have you ever heard of Night Owl? You should check them out. Night Owl is a company in the Philippines that was founded by a mortgage professional out of Northern California. So it is a company that is solely devoted, as I understand it, to the service of loan origination. And all of their staff are trained to process loans, to act as executive assistants to loan originators, to act as LOAs for loan originators. I mean, they're pretty good from what I understand. I have several clients who use them and swear by them. The nice thing about that is that you can start to, whether it be Night Owl or whether it be you going to a temp service or putting an ad out in one of these 13 states you've visited, there are a lot of people out there that know how to facilitate loans right now that are unemployed. So what I would suggest is that you start bringing a person or two like that aboard. And perhaps you've already done this because you referenced having 3 people on your team that are part-time. And then
two of my people are actually virtual assistants in the Philippines.
Okay. And then you pay per file. Okay. I think that's the smart way to do it. Pay more money to not have the pressure if things don't turn. Pay more money per file, put them essentially on a commission structure with you. So $600 a file, $700 a file, whatever it is, might be an outlandish number if you do 1 or 2 loans, but it's actually a safer play. You can then identify, Scott, who are your A players? Like, okay, who's the person out of these 2 or 3 that I'm giving 1 loan to here and there that I think is performing and that I work really well with? Like there's a cohesiveness to our relationship. And then you start to earmark that one person and maybe start giving them 2 or 3. And then when it pops, you fill their pipeline up and they become a part of your team. That would be the strategy and approach that I would take. But here's the reality, and I think you intuitively know this, which is what I love, because even though you haven't been through this, I could see how your brain works. I tell my clients this all the time. It's like, okay, so let's hypothetically say you don't make the hire. Let's say you don't get your ducks lined up. And let's say rates drop. And let's say they drop big. And I've seen that happen many times in my career where the Fed just surprises.
This scenario terrifies me.
Yeah, because
absolutely terrifies me.
How much money do you make per loan? On average?
Probably 4 to 5.
4 to 5 grand. So we'll say $4 grand. Okay. So let's say you have 10 refi opportunities and you're not able to take advantage of them because you don't have the proper staffing to take advantage of them. You're leaving $40,000 on the table. That's a lot of money. Okay. Yeah. Far too many times I see originators have to pull back the reins on that thoroughbred because they don't have the facilitating abilities of a staff that they've hired. So now is a very important time, and I want to shift you into a little different mindset here for a minute. So I used to play a game with myself when I first started in the business. I used to do a lot of consumer direct marketing. A lot of direct mail in the Los Angeles Times Sunday edition. I had a telemarketing team that worked for me, et cetera. And I used to play this game when I was doing 4 or 5 loans a month. And I would pretend, I'd pick a loan every month by name, the Johnson file. Okay, that deal, they double apped me and they went with somebody else, or their appraisal got cut, or there was a surprise time bomb. I would make up a story. I'd literally create like a story around it. I'm like, that deal died. I lost that loan. I thought I was going to get paid on it. I lost on it, but I didn't lose it. And when I get that $3,000, I would take that $3,000 and reinvest it into my business. So I wouldn't mentally spend that money, which was what most originators do. They say, oh, I'm going to fund 5 loans this month. I'm going to make, $20,000. And they start thinking about the new car they're going to buy. Okay. I would be like, no, I'm only funding 4 this month and I'm only making $16,000. And that extra 4, I'm putting back into another consumer direct marketing campaign to generate more leads. I would reinvest into my business. I had money that I'd earmarked for growth and expansion. Most originators don't think like that. They're working month to month and deal to deal, and they spend what they make. I want you to do the same thing as it relates to building your team, because the thing is, bro, is that you're off to such a hot start and it's only going to get better. And the only thing that can hold it back is if you don't have the structure to facilitate the opportunities that you're creating for yourself. I mean, right now, you're probably taking what What do you take? What would you say the average number of new applications of real loans that you're taking on a monthly basis over the last 4 or 5 months? Like 5 or 6 new ones, or more than that?
8, 9.
Okay, so right now you're bringing in 8, 9 new ones. All right, now let's future fantasize. What if rates were at 5 3/4? What if they're at 5.5? What would that number probably go to?
15.
Okay. So now you need to think about, what does that look like? What do I need in terms of an infrastructure to be able to facilitate 15 loans a month consistently? Because if you don't build that now, what's going to happen is this. You're going to get a full pipeline and you're going to be stressed out. You're not going to be getting in at 5. You're going to be getting at 3. You're going to be leaving at 8. Your adrenal glands are going to be shot because you're going to be so much operating under the hormones of stress, and you're going to be the one processing your loans. And you'll fund those 15 loans with blood, sweat, tears, and you'll come away with battle wounds. And next month you'll fund 2. And the reason next month you'll fund 2 is because the month before you were the one processing those 15 loans and you weren't creating new opportunities. So this is the thing that most originators miss, and it's why they have this peak and valley syndrome, where they have one good month, one terrible month, and then another good month and another terrible month. But boy, brother, what would it look like if you were funding 15 every month? That'd be,
and that's a small number to me.
That'd be $720,000 a year gross, right? Based upon your $4,000 formula. That's life changing. I mean, that's an entirely different life in every way. Right? Probably a new house, or maybe a second home, or retirement funded, or whatever. I mean, all kinds of things, donating money to your favorite philanthropy, or all of the above.
Yeah.
So let me check in and ask you this. Like, let's get granular with this. Right now you have 3 people. What are the job functions that they provide?
So, I have one working on gathering all the information that I use a couple of different tools to be able to go out and chase refis with. I use Property Radar a lot. It kind of helps give me an idea of where, because I can see who the loan's with. I can see how long they've been in it. I can see what the interest rate is. I can see all that stuff. I have one who handles, that's a VA. The other VA handles everything to do with the pre-approval process. So once I bring the loan in, then because of my loan atlas teaching, I introduce them to Ja, is her name. And Ja then takes over and runs the pre-approval process, gets the documents we need, gets the 1003 done, everything. And then she gets it right to the point of doing the pre-approval and getting it to that point. And then I will take a final look at the file before we send out the pre-approval. Okay. And then the other is, I hired him as, he's an ex-Navy vet. He's very, 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 he is everything I'm not. He's very organized. I'm a 30,000 foot guy, self-professed, and I can't fix it. And I don't want to fix it. So I have to surround myself with one person that can get muddy and get down in the dirt and make sure that things get done properly. So is my operator. I'm sorry.
Is he a processor? Who processes your loans?
No, I actually use third-party processing.
Okay. So what does he do then?
So he's my director of ops. So
Ja's your LOA/transaction coordinator, but what's this gentleman's name?
Matt.
So what does Matt do as a director of ops? What are some of the high performing tasks that he provides?
So anything he can do to shove stuff through the pipeline. So he watches over the processor. He answers questions. He helps them get their stuff together so that they can do their job. He helps with Ja. He manages both of the VAs. So he knows what we need to get done. And so he manages that entire process. So that I don't have to. He's literally forced me. And it was something I needed, I think. It literally to the point where I don't even get involved anymore. He won't let me. which
I like the fact that he won't let you get involved. That's music to my ears because that frees you up to go out and find more deals. Okay, which is the role that you want to be playing. I can tell from just our interactions and what we've discussed in terms of you being a great networker and having a big social network, that you need to be the rainmaker. Okay. I'm not 100% convinced that the person, this gentleman that I forgot his name already. What's his name again? Matt. I'm not 100% convinced that Matt's necessary. Okay. And I'm not trying to get you to let him go, but maybe we redeploy him elsewhere. Why, if I'm going to walk through what I heard you say, and then I want to understand where the breakdown might be. So the person says yes to you. Great. You introduce him to Ja. Ja takes it over from there, gets all the documentation collected, gets everything signed, gets it all set up properly for processing, right? Sends it into your contract processor. Your contract processor processes it. Why does Matt need to oversee anything? If Ja knows what she's doing and does a great job of thoroughly vetting and gets a complete file to your processor, you come back with hopefully not a ton of conditions. Who's working those conditions, first of all?
So that's where Matt comes in.
Okay.
So Matt, and when conditions come back, then the processor will handle some, but I want somebody in my office to control that process. I don't want to leave that to a third-party processor all the time. So Matt, that's where Matt really gets involved. He gets involved in making sure the conditions are getting handled. And I'm only doing this from a standpoint, Tim, from experience, that I've had a couple of deals that went to shit because they weren't followed up on in a timely manner. And I need somebody to be able to do that. So
are the conditions subdivided? So like what types of conditions does the processor work, and what types of conditions does Matt work?
So he's really making sure that the processor is handling the conditions she's supposed to happen, but anything that's front-facing, dealing with the client directly, I want Matt to handle. I want somebody from my house handling our customers. I don't want processor doing that.
What about the agents? Who's communicating with the agents on anything?
He is.
Okay, so he's handling customer and referral partner relationships, whereas the processor's handling like back-end stuff like organizing the doc signing and funding and maybe working with the title company on a title cert or appraiser on another condition or another comp or something like that. Is that accurate depiction?
Pretty accurate, yep.
Okay, so I don't fundamentally have a problem with it, but there are two watch-outs. Watch-out number one is that you have three people that are communicating with your customer, you, Ja, and then Matt. So the baton needs to be passed properly, and you know what I'm probably talking about in the baton passing scripting and the loan atlas, but you have to make sure you have that nailed because you do not want the customer to be confused as to who they're supposed to be talking to. And that's where it's so important that it's a seamless baton pass with proper scripting and proper pre-selling of the teammate. So you as an originator need to be explaining the process to your client to the extent that you're not already at the beginning. When they say, yes, great, let me tell you how this is going to work. The next person you're going to talk to on my team is my partner.
Is actually Matt.
Okay. Next person you're going to talk to on my team is Matt. Here's Matt's role and function. Then you're going to be talking to Ja, I assume, at some point. Okay. And Matt needs to pass the baton to Ja and to pre-sell her. But now you're ping-ponging back and forth because the approval comes in and now Matt's entering back into the race. So I'd be a little bit careful about that. And the reason that I'm highlighting this for you, bro, is because you remember 7 minutes ago or whatever it was, I painted a picture of you funding 15 loans consistently on a monthly basis. What happens is that weaknesses are exposed with the more volume you have. You can get away with passing the baton back and forth and having several different points of contact, which creates a lot of additional communication between you and your teammates and the consumer and the realtors and all that kind of stuff. You can get away with that when you're funding 5 loans a month. But trust me, I know this to be fact. When you get up to funding 25 loans a month, okay, that's when all of the flaws in your system will start to get exposed. Even at 10 or 15 loans a month, you'll start to feel an inefficiency because there's just so much volume. So what I would really like to see you work towards is, and answer this question for me, why is it that consumer goes to Matt next and then to Jaw versus just going to Jaw and then straight to the appraiser and then Matt works conditions?
Because the communication, Tim, for me, Matt is the point of contact for everything once I get them into the system.
Okay.
Jaw, all of the things that we do with our VAs in the Philippines are all email driven projects. They do not have face-to-face Zoom. They don't have any interactions where they're physically talking to the client. Everything is for Ja is document gathering. That's all it is. So with her doing that, Matt's able to check on that to make sure we're moving, because I'm pretty hard on them if we're not getting all of those documents within a 48 to 72 hour window.
Sure.
And I think the only way that we can properly do that, because Matt has the ability to communicate with them and pick up the phone if they need to. And then I'm the last resort to pick up the phone and say, hey, I thought you wanted this loan, dude. And here we are. And I don't have anything from you. And we're 3 days in, which means we're already 3 days behind. I can say those kind of things. Matt will say it differently and communicate it differently. I'm the one that's going to maybe drop the hammer, I guess, for lack of a better term, when it's time to. So, but all of the points of contact are with Matt, pretty much with the borrower.
Jaw's working behind the scenes, maybe corresponding electronically with them, but Matt's the primary point of contact. I actually like that a lot better because it's less confusing for the consumer. Jaw's almost more like Matt's assistant at the end of the day.
Yes.
And
the VAs that, because my plan, Tim, is that we'll come up with things where Jaw's only going to be able to handle so many. I think we're going to have the other VA handle some of that workload too, and work behind the scenes. And then Matt runs the VAs. So he's responsible. They're responsible to him, not me. I'm literally trying to completely clean my plate at this point of once I introduce and I pass the baton to Matt at the end of the honeymoon period with a client, I guess would be a great way of putting it. Then I check in with them maybe once a week just to say, hi, everything going right? Are we encountering any problems? How's Matt treating you? Has the process been smooth so far? And it's literally a 2-minute call and I'm out and done. And then I don't come back again now until it's closing time.
But multiply that by 40 loans in your pipeline. A 2-minute call every week to all 40 of them is very cumbersome. You want to ultimately get to the point where you trust your team so much. They're so good. Your clients like them every bit as much as they like you.
I want them to like them more than me.
Absolutely. You're not even re-entering the race, so to speak. You are just simply, your job function is to go out and create more deals. And that's where your business is going to explode. And I really want to applaud you. I mean, I want to remind everyone that's listening, it's a man who's been in the business for 18 months. And he's already scaling his team. He's already thinking out of the box on how he's going to capitalize on refinance opportunities when they're there. And oh, by the way, it's not like he has a robust database of past clients because he's only been in the business 18 months. But you're thinking about how to generate refi opportunities with your network, which is, I think, something incredibly important for everybody to understand, because there are a lot of people that have not been in the business for a very long time. And they say, well, I don't have a lot of refi opportunities. Yeah, you do. You just need to get out there and talk to everybody you know and tell them what you do and explain to them your value proposition about how you manage debt for people, and ask them who they might be able to introduce you to that would benefit from your services. It doesn't mean that you can't go out and start meeting and talking to people right now and setting up strike rates for them, so you are well equipped and prepared for when rates drop to have some very successful months. What else, if anything else, comes to mind for you as it relates to this that I can help you with? Does that create any clarity for you? And
oh yeah, 100%. Yeah.
Anything else that's challenging that you're trying to solve for?
Do I want to open this box? We had a conversation the other day about one of my main goals, and that is to retire Brenda. I want her to have, she's been the rock that has allowed me to do all the things that I have done. And I want to reward her by letting her, and she's very successful at what she does too. She's a rock star. I mean, she's a director of marketing and communications for the Kelley School of Business at IU. She's legitimately a rock star. To the point when I'd put out marketing pieces, Tim, it don't go out until I let her look at it. It just doesn't happen. So I look at her and I watch how she's been for me for now almost 25 years. And I want to be able to look at her and say, honey, you've earned this. I need you to get out. I need you to do what you want to do. It's your turn. And that's when you're starting something new, like I'm starting here, it's hard for me to envision that for her, but I want to. I mean, the health insurance comes from her. We get great health insurance through the university, state sponsored stuff. And that's the one thing she worries about. I can go on Medicare tomorrow and no big deal, right? But she can't. She's 10 years younger. But I really, 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 it's my number one goal. If you had to pin me down to one why, it's her. And I really, really want her to be able to have the freedom to go play golf 3 days a week if she wants to go play golf 3 days a week and do what she wants to do, because she's so tied down to what she does now that she can't hardly breathe half the time. And I want her to start being able to do that.
So you have your driving force, your prop motor, your fuel, if you will, which is beautiful. I mean, I think everybody needs to have a purpose that drives their activities, and you've just identified what yours is. What's the hang up? I mean, what can I coach you on as it relates to that? Is there a challenge that you're experiencing relating to this issue, or?
A little bit. Yeah. I just, and maybe it's the fact that I don't know what lies ahead. So I'm a little hesitant to just say, do it now, because what if everything falls flat on its face? I'm a little scared of that.
Well, maybe it is premature. I mean, maybe what I would consider doing is, like, do you have a personal budget that you're aware of? Like, you know how much money you spend every month, how much money you have coming in, et cetera?
I didn't until I started this job. I do now, but I didn't until 24. Not really.
So, I mean, I think the identification of that number is very important. Otherwise, we make emotional decisions. I think there's a lot of emotion behind this conversation that we're having. I mean, there's a lot of purpose for you, which is, I want to feel proud that as my wife's man, that I have created a situation for her to where she can relax now and not have to work so hard. And I can really feel the heart and intention behind that. And it's super beautiful. And I think that we have to identify, like, when do we know that has arrived? Because until which time we understand what the true financial mechanics are of it, then we're going to be prone to making decisions based upon emotions of fear, emotions of enthusiasm, the full gamut. So if you're not there yet, then the question becomes, where do you need to be? Like, how many loans on a monthly basis do you need to be funding, which will net you X amount of dollars consistently on a monthly basis, to where she has the freedom to make a choice to retire herself based upon the fact that you've built something very sustainable. So I would recommend that you sit down together and pencil that out, and then make that your target, right? And it's probably not like, hey, let's say it's 7 loans a month. It's probably not the first month that you fund 7, right? It's, it's probably over a period of time. Like, I've funded, over the last 6 months, 45 loans. Okay. And I still have a pipeline that is solid. It's growing. I'm seeing evidence of referral partner relationships that keep coming back to me over and over again. This is sustainable. Yes, it will go through its ups and downs, but I'm not exactly going to be going down to 0 loans a month anytime soon is the likelihood of it. I think that you need to create that type of stability. But one of the things that we had talked about the other day in that group Zoom call was around agreements that were being made. And I'm curious as to whether or not you want to share any more as it relates to this issue around, agreements. Like what is the agreement that you have with her? Is she even aware of the fact that you feel so passionate about what it is that you just explained to me?
We've had the conversation. Yeah. I know the number. You're telling me I need to figure out where I need to be. I know what that number is. I know it. I've run the numbers. I've seen everything. I know what the number is. It's just, but I view this business as so feast and famine. Someday, and if I'm doing 15 loans a month, Tim, on a regular basis, and I'm consistent with that, I'm good. We could do whatever we want to do. But what if it goes down to 3 or 4 and it gets short 1 month? Yeah, those are the fears. I mean, I went through 24 where I didn't do very much business, and a lot of people didn't do very much business in a lot of cases. I understand and I see the light at the end of the tunnel, and I realize it's not a train right now coming at me, but the what if factor still weighs in my head.
Well, the what if factor is fear. Okay. I mean, that's fear-based thinking.
Yeah.
And the thing about fear is it can be a tremendous hindrance, and it can also be a great ally. Okay. And I think that there's something called healthy fear. And I think that that's what you're experiencing. I mean, I think these are very intelligent questions that you're asking. Well, what if it were to drop significantly down, my production were to drop significantly down? Okay. I mean, that's something that unfortunately a lot of people didn't prepare for going into 23, 24, and 25. And that's why they've been struggling. So the key number is, what's the number to not have my lifestyle change? What's the number to have all of my needs met? Okay. And if that number is 6, consistently 6 a month, 72 loans a year, consistently $300,000 a year in income based upon that $4,000 check. Okay. And you're doing 15, you could take a real logical look at it and say to yourself, okay, even if all hell broke loose and I dropped by more than 50%, I'd still be okay. Or you could also say, all right, we know 6 is the magic number. Let's have a full year at 15, and let's take the income from those extra 9 every month and put it away. Not spend it, not extend ourselves and go crazy. Let's put it away.
That's already happening.
Yeah. So
we do not spend my money at all. It goes to the end game. We don't use my money at all.
But I think you had expressed the other day, correct me if I'm wrong, a little bit of a concern that you had that the hours that you're putting in, and the things that you were deciding to say yes to in your life, were so extreme, perhaps, that it was causing you to have less connected time with her. Is that accurate?
It's very accurate. I'm here 12, 13 hours a day a lot of times. Now, I'm glad she works too, so that's not a problem. When you talk about making agreements, this was one of the agreements. One of the agreements was that I was going to bust my tail and do what I needed to do, and I've front end invested. I said I'm looking at 5 years. At age 70. Now I'll take another look and reassess and say, where are we at? I'm 70, she'll be 60. So, but I am worried, even though that we made that agreement, that sometimes I'm being a little selfish. And you made the comment to me the other day, you maybe need to reassess and have another conversation and re-up your agreement. And I agree with that. I think I'm going to have to do that because I just want to make sure that I'm giving her the time that she needs from me. That's because I can stay in the office. I can. I've done it plenty of times. I promise you it's 4:30 on a Friday, which means we probably ought to be having a cocktail somewhere. And I'm in a conference room. My office is down the hall and I guarantee you I got 3 messages right now saying, what are you doing? Where are you at? Are we meeting? What are we getting? So I already know when I go back to the office.
First of all, you've got my cell number. I'm your alibi. So you can give it to her.
Yeah, 100%.
100%. But here's the point that I want to make that I think is missed oftentimes. So you have an agreement and the agreement was forged 18 months ago, perhaps. All right, I'm going to start a new career. I'm going to build this business. I'm going to work my ass off. And we've got a 6-year goal. And by the time I'm 70, we want to be in this financial situation. And she's like, yes, I'm good with that. You go ahead and make the sacrifice. Thank you for doing it. I think it's just important that we check in every once in a while, every 3 months or so, over a cocktail. Hey, let's have a check-in. How's this working? Are you okay? What do we need to do to recalibrate here? Do I need to make any new commitments that I'll be home, every Tuesday at 4:00 and we'll go for a walk together, or we'll have a date night every Wednesday night, or we'll take a weekend away unplugged with me turning my cell phone off once a quarter. There's all kinds of iterations to this because the thing is that relationships need to be nurtured. I mean, I've been through a few marriages myself, right? And maybe you didn't know that, but I'm on my 3rd marriage and God willing, the last one. And it's year 2. So between the two of us, well, I'm strike 3 already, bro. You're still in the batter's box. But
I saw the first getting out of the first ones as a win. No, Tim, trust me.
Yeah. Me too, especially on the first one. I think that shy of maintaining and nurturing the connection, things can start to sever, right? And we can start to just not feel as connected to our partner as we're capable of feeling. So that's why I think a check-in on a consistent basis, every 3 months or so to go, okay, let's recalibrate where we at. How's this working? Do we need to adjust anything? Because what I was sensing the other day was that you're operating off of a worry, which is, we made this agreement. She said she was cool with it, but I'm worried about whether or not she really is cool with it and whether this is in any way truly affecting our relationship because I'm working 13-hour days. And the only way to really know is to have the brave and vulnerable conversation, which I know that you're capable of having. And like I said, I suggest a rhythm to that of every 3 months or so to where you're just checking in and seeing how things are going. And then you can course correct accordingly.
I thought it was fair the other day when you talked about it. I still think it's fair. So, yeah.
Well, I think it's time for us to get you out of this conference room that you're in and over to a date night with your wife. And I wish you a happy weekend. And I want to say thank you so much for taking the time to be a part of this episode of the 360 Experience with me, being vulnerable, sharing with us your successes, sharing with us some of your challenges. I'm certain that those that have listened will find that this was very valuable and will be grateful to you for bringing your full self to the conversation, because I'm sure that they learned some things from it.
Well, if it's not for you guys, I would not, I can tell you, and I'm not saying this just because I'm in your podcast. I am not where I am right now, advanced after 18 months without being a part of this great community. I watch as many of the teachings as I possibly can. If I don't watch them live, I watch them in recording. I just went over 20,000. I'm a competitor, so when I see the scoreboard and I see what I just went over 20,000 points in the Loan Atlas. So again, if not for you guys, I'm nowhere near the educated lender that I wish to be. So I thank you and everybody else. The entire faculty has been great. A lot of them have reached out to me personally and said things and said nice things. And that's because you all don't know me in my fullness yet, but you will soon enough. So, and I want to, I do know about your love for baseball, and specifically, I do know about your love for the Dodgers. And so I am extending the offer at some point in time. It probably won't happen this fall, but next year, at some point in time, I am going to fly to California. I am coming to see you. I still have a lot of friends that I umpired with in the minor leagues that are still major league umpires today. And we will get the cheap tour of the bowels of Dodger Stadium and go to a couple of games and have Dodger dogs and have a good time.
You got a deal. I would love that. First of all, thank you. And I would really love that. And secondly, is that I have a great story for you that I won't tell you on air, but we need to make sure we connect on it, about my dream year of 1988, when as a 21-year-old intern at KTLA News in Southern California, I had press passes for the entire year.
That's a beautiful thing.
And some very interesting moments down in the locker room after games and on the field before games. But that's for another time, my friend. I definitely would love to have that. Let's make sure we plan that. Thank you for being such an active member of the Loan Atlas. Thank you for all the love and energy that you bring into that community. It is not unnoticed, and we are very grateful for it.
Thank you.
And everybody, thank you for listening. I hope that you got a lot of value from mine and Scott's conversation today. Thank you very much.